Ladies and gentlemen, good afternoon. I'm Paul Mullins, and on behalf of Kallanish, I'd like to say a big welcome to you to the Global Steel Markets webinar. 2020, we're only 4.5 months in, but already I think we're pretty certain that in future years, it'll be remembered as the year of the coronavirus. And obviously it's had a massive impact on the global economy, both in terms of depth and also reach. And obviously that itself has extended to the global steel industry. And normally we would expect to be in contact with our markets through face-to-face meetings and conferences. And in the last 3 months, we've had far higher levels of engagement with people on an individual basis than we would normally. Normally in April, we'd hold our Vietnam conference, and we had our Milan conference scheduled for the beginning of June. Obviously, neither can go ahead for obvious reasons. So with the level of queries we've been getting, plus talking to our clients and our delegates who would normally attend the events, plus our subscribers, people have just been saying, could you please do a webinar, because we really value the input of your editorial team. And so we've been listening to people, and we've decided that now is an appropriate date to start a series of webinars. And so today what we put together is presentations from 4 of our editors from around the globe. So we'll start off with Emanuele Norsa, who's based in Milan, who'll give an overview of the European market. Then we'll move to Thomas Gutierrez, who's our Asian editor. Then we'll flip to Pittsburgh, where Dan Hilliard will give us a review of the Americas. And then we'll flip back over to Adam Smith, who will give an overview of the Middle East and CIS, and including Turkey. We will be, obviously normally at a conference, we'd have a question and answer session. Today is no different. However, what we'll be doing is, instead of stopping for questions at the end of each presentation, we'll gather the questions together. You'll see on the right-hand side of your screen, you should see a chat function. So if you type your questions in there as we go through, we'll get them together, and I'll try and put through the most frequently asked ones, the most prominent questions to the team. And then we'll deal with those on an individual basis at the end of the session. And then hopefully afterwards, we'll get something in writing to you for the questions that we haven't managed to deal with. So without further ado, I will hand over to Emanuele Norsa in Milan for him to give us an overview of what's happening in Europe. Emanuele, over to you.
Hello, thank you, Paul. Welcome, everyone. So first of all, let me take this opportunity to say hello from Milan. And the idea was, when I was invited to do to this webinar, to talk about how Europe is entering in phase 2. Phase 2 is a term that we use in Italy. It's just the phase in which we are entering now, meaning the second phase after the emergency, after phase 1, when we leave with the virus, we start a new normal, and we restart the economy slowly in a way. So I'm going to be talking about production, prices, and protection. Of course, all starts with a P. Let's start with the production. We are entering phase 2 with this situation that you see here, of course, which is the chart from the World Steel Association. As you saw, in March, there was a big slump in terms of output. The lockdown started first in Italy and then expanded across Europe. Italy, the second largest producer in Europe, had a slump of almost 40% year-on-year in March. Others have a smaller adjustment. What is interesting in that overall, anyway, during the first 3 months, the adjustment was by 10% global, well, in Europe, across Europe, with only France being less impacted of the big output of the big countries with big output in Europe. As I said, the lockdown started in March, but April was also a month of lockdown, so we expect April levels to be negative compared to last year. The first recovery could be seen in May, but the real recovery will be probably only seen in June. So the way we're entering phase 2 is, of course, with lower crude steel production in Europe, as you all know. And this is, of course, leading to speculation, but also decision from big groups. I've put here 2 of the major European groups that are thinking either through speculation or through announcement of maybe changing some of the organization of the group. What is interesting is that crises always lead to reorganization always lead to a change of the way the production is controlled. In 2008, 2009, for example, we had the big reorganization of ArcelorMittal, which ended up with 2011 and 2012 with the closure of two of the most important, well, of two major integrated sites in Europe, which were Liège and Florange. 2020, with the coronavirus, we still don't know where it's going to lead, but it's for sure that Southern European output has been slowed significantly by ArcelorMittal with the idling temporary of one furnace in north of Spain, one in Fos-sur-Mer, and one in Taranto in Italy. But there are speculation, of course, that first of all, the Fos-sur-Mer mill could be stopped completely, crude steel output, by July. I mean, at the beginning it was in June, but now it has been postponed in July, so the decision is still ongoing. And it's from this week an announcement from the Italian minister that was saying that they have a feeling ArcelorMittal could be planning to leave Italy altogether using a clause that it's part of their contract. So reorganization is definitely in the card of the biggest group, ArcelorMittal, but also other major groups like ThyssenKrupp that announced, as you all know, this week the intention of consolidate and merge. I was speaking with Marcel Genet just a few weeks ago, and he mentioned the fact as you probably know, he's always a big supporter of electric arc furnace against blast furnace. He mentioned many times that it could be accelerated, a transition from blast furnace to electric arc furnace, a transition that was already ongoing, not only with ArcelorMittal, for example, announcing in Italy that it would invest in electric arc furnace, but also, for example, Liber Steel in the UK. So this is another transition that could be accelerated. Of course, prices, where we are now, where are we starting phase two? Prices are under pressure. They're still not at the lowest level seen in Q4 2019, so they're under pressure, but holding up relatively steadily. But what is interesting, this is hot rolled coil, the spread between import prices and domestic prices is widening up. So unless there is a real recovery now, which could be happening with iron ore returning to September levels, if I'm not wrong, over $96, unless Europe import prices pick up, European prices will have to correct. So there is definitely a gap there to watch and to align. And because we're talking about HRC prices, I would ask maybe Paul to start with our first poll for the webinar that you can all have a look and answer. So when do you expect the EU HRC prices to jump back? And you can select an answer, and then once you select it, you can send it, and we should see in just a few seconds the results of this poll. The options are, of course, June 2020, Q3 in general, Q4, or Q1 2021. We are just waiting for.
Yep, got a few more polls coming in there, Emanuele.
Yes.
We've stabled out now, and we're closing the vote in 5 seconds.
Okay, perfect. Okay, so yes, I don't see the results. Oh, yes, here it is. The results, so 37% of you believe it's going to be in Q3 2020, which is actually what I would have voted if I could, because as a speaker I cannot vote. Q4 say it's sorry, 30% is in Q4, so more than, well, almost 70% believe it's going to be by the end of this year. It's interesting to see that there is a small minority that believes this is going to happen in June. To be fair, there is a likelihood that something will move in June. As I was saying, if iron ore keeps recovering in China and going above maybe the $100 in the next week, it could be already a push for import prices to pick up, and therefore for prices to pick up in Europe as well. So we move back to the slides. Thank you very much. And as we said, on prices, of course, we always need to look at scrap as well, especially if we look at sorry, in more details into Europe, scrap is also recovering across Europe. May contracts have been going up compared to April, and the problem is there is tightness of supply across Europe, so there is a recovery on scrap prices. If Turkish prices continue to hold, it could be another indication that prices are on the rise going into June. As I was saying, of course, after production and prices, we have protection. Protection is the third element that we need to look at, maybe the most important for some of you listening to. You all know that there is a review of the safeguard quotas ongoing. We should hear very soon by the European Commission. Eurofair is asking a cut by 75%. It's unlikely that such a big cut will be implemented, but it's very likely that a reduction will be confirmed, which is a reduction on the new quotas that will become available from the 1st of July. This is already one element interesting because, as you know, for some of the quotas, for example, rebar from Turkey, the material is already ready the quotas are already ready to be used, and last year they were used in 2 days, and we expect the same to happen this year. So of course, a dramatic reduction of the safeguard quotas would mean that there will be some volume that will have to pay 25%. The same goes, of course, with the new investigation on HRC from Turkey, the anti-dumping investigation, open officially by the European Commission. We don't know yet, but it's taken a long time. It's been on the paper for a lot of time, but it's now there, and we believe by the end of the year there could be a decision on this. Just to finish anyway, even though imports will become an element of pressure, of course, I agree with Eurofair saying that imports still remain an element of pressure. We also need to remember that coronavirus seems to be a crisis that takes the market to become more regional. So it's a very difficult situation now to assess the market, and especially because then when we look at the year 2019, imports from third countries decreased by 11.5%. So if the same trend is accelerated into 2020, it starts to become difficult for importers to justify new limitation on their imports. So I will stop here. I will be available for more questions, and I will pass it on to Thomas Gutierrez for the Asian section. Thank you very much.
Hi everybody. Thanks for joining us today. As Emanuele mentioned, I'm going to be covering what's going on in Asia, especially with a focus on China with the coronavirus and what's coming up as a result of the coronavirus. So first thing is that we had new data last week on April. If you look at what had happened in Q1, there was obviously a very significant decline in end user buying. This is end user buying, so compensated for net imports and for inventory change. And it was down almost 20% over Q1. So we had a fairly significant fall in January, though that was really before the coronavirus. That was mainly due to the early Chinese New Year. But February, if you consider that February had been expected to be considerably higher year on year, that was a very poor result, and March also obviously recovering very slowly. But the April data that was released on Friday was much more positive. China's already making up some of the demand that was lost in Q1. It still has some way to go, obviously, but there's clearly been a fairly strong recovery in terms of end user buying, driven by construction, infrastructure, even automotive starting to come back a little bit. But what we saw over Q1 and what's really still slightly hanging over the market is the inventory level. The immediate response to the shutdown of the Chinese economy at the end of January, the response by CISA and by the Chinese mills was really not to cut production, but to try and maintain production for as long as possible. So the focus in the first several weeks was really around maintaining the supply of raw materials and ensuring no disruption to normal activity. So it was little surprise then that inventory levels surged to record highs, more than double where they were at a similar point last year. That started to improve in March, but the improvement in March is obviously coming from a very high base. The improvement has been fairly steady, and now the pace of change has been quite sustained, and that's been fairly positive. But obviously, you still have inventories around 50% higher on year compared to the similar period last year. I'm just trying to move along the slides right now. The slides seem to be slightly stuck, but I'll continue anyway with what we have so far. The next slides were basically going to be about the comparison between construction and infrastructure sectors and the automotive sector. Obviously, all sectors were really shut down completely in February, and March was a very slow recovery for almost all sectors. But you did start to see a bit of differentiation in sectors at that point, where construction began to improve at a fairly steady pace. Construction real estate investment was up year on year from March, and up at the more than 7% year on year in April. And that helped to encourage sentiment, as well as obviously to bring down rebar inventories. For automotive, the picture is less bleak, but there is a recovery. So if you listen to the automotive manufacturers, they were all very happy in April that they had a year-on-year growth of about 1.2% in production. Here we go, there's the slides. But it's worth bearing in mind that the recovery in automotive production in April was only compared to almost a 15% year-on-year decline in April 2019. So even though automotive has recovered, it's only recovered to the level of its worst full year in more than a decade. So it's all relative and still some way to go in terms of the recovery. Now, however, we have a situation where really sentiment has really been pushing up prices very aggressively. And a lot of that is around the two sessions, which is the National People's Congress and the National People's Political Consultative Congress, which start on tomorrow, in fact. In particular, on Friday with the government work report, which is typically where more detailed economic policy is announced in China. There's a lot of speculation around that, and obviously it is all very speculative at the moment. But some of the ideas that have been raised are that local government special bonds could be increased to 4 trillion renminbi from 2.5 trillion renminbi this year. So an additional 1.5 trillion renminbi of investment on top of what was originally planned. Most of that goes into government projects of various kinds. So a significant proportion of that is infrastructure, and a fairly significant proportion of that is steel-intensive infrastructure. There's also talk about the fiscal deficit being increased over 3% for the first time in almost living memory. That would be the central government budget, but that would also imply a significant amount of government support in various areas. And then also there's talk about the GDP target. China had set a goal to become a moderately prosperous society by next year. That had implied a GDP growth of 5.5% this year. That obviously is extremely unlikely to happen now. But there's still talk that perhaps instead of achieving that target this year, they will spread the goal over this year and next year, in which case there would still be significant stimulus needed to achieve that kind of growth from the second half of this year and next year. So at this point, we're also going to run a quick poll. As everything is speculative, Paul, if you can set up the poll, and we'll take a look and see what your expectations are of how much stimulus you expect to have from the Chinese government over the next couple of weeks. Will it be just enough to achieve political goals, or will it be all-out stimulus to stimulate growth? We'll give you a short time to post your responses, and then we'll have a quick look through them.
Thank you, Thomas. At this point, I'll just jump in because somebody asked a question during the previous poll about how many people were voting. On the last question, we had 52 votes. So obviously, the more people that vote, the more representative the results are of the audience. Votes are still coming in, so we'll give it another 10, 15 seconds. And we'll give it 5 more seconds, then we'll close the poll. Right. Speak now or forever hold your peace.
Thanks, Paul. Interesting. Yeah, I think I mean, people clearly have a very good read on how things work in China. 58% voted for enough to become a moderately prosperous society in 2021. In other words, enough for Xi Jinping to meet his political statements without having to back out of his promises. Then 26%, just enough to prevent collapse, which perhaps reflects the view that China's economic reforms are also extremely important, and there is some pressure to minimize stimulus in order to ensure that investment does not hinder future growth, and 60% for all-out pedal to the floor stimulus, which again you can never rule out because there's also pressure on jobs, on ensuring businesses are earning revenues again, and that there isn't a fairly significant financial crisis in the second half of the year, which obviously would happen if there was no stimulus. As I said, we will find out really from Friday, so all bets are off, but maybe next time we have a webinar, we will take a look again at the results of that poll and see which of us was right. Okay, so the impact of that speculation, really, of increased stimulus is that prices have really gone a bit haywire for iron ore. Iron ore has become very strong. The rally started really based on tight supply, especially from Brazil, but also from Australia earlier in the year. And obviously there have been some incidents in the last week or so, which increased also a little bit of speculation on the supply side, including obviously the closure of the Jimbumar mine by BHP for half a day on Monday, which won't have a significant impact, but obviously in the current climate has sparked a few worries that if a longer outage did occur, then that would be a very significant impact on pricing. But really the demand in China is the key. The situation in Chinese ports at the moment is, we have Chinese iron ore port stocks, which are down fairly significantly on year. In general, there's a fairly tight supply. Chinese steel production is strong and has been increasing. So we're going into a fairly tight market just at the point when stimulus might be announced. And so obviously there's potential for upside. In terms of prices, as Emmanuel mentioned, we did get into the very high 90s. This is a little bit of a pullback today, but really just a correction from the very rapid increases over the last week. If in terms of whether 62% fines can hit $100, again, it really comes down to what comes out of Chinese government policy in the next few days. So we'll see there. For steel prices, the reaction, both in terms of the decline for coronavirus and the recovery, have been a little bit less dramatic in China, and certainly less dramatic in China than elsewhere in the world. So although you did have a decline in prices, firstly, a very sharp decline, especially of HRC, immediately after the ban on activity and the shutdown of the Chinese economy at the end of January. You then really saw prices move in a fairly standard range since then and into May. So only now are we really seeing a more steady increase in prices. Having said that, Chinese steel producers have been profitable. So production has been increasing, and also that's driven a desire for imports. So that's partly due to high iron ore prices and so on, which have created a fairly steady demand for semi-finished products. And also because generally the fall in Chinese steel inventories has given traders room to speculate on the possibility of bringing in large cargoes of various steel products over the coming months. So if we look here at some of the data for imports, this only really has the detailed data for Q1, because April data doesn't come out for another week and a half. But you can see there's a very strong year-on-year increase. The increase in imports actually really started late last year with a lot of bookings for the end of 2019. But that has been sustained in Q1. So if you look at the Q1 year-on-year increase in imports, the key drivers of that really have been the Middle East and Southeast Asia, as well as Korean HRC. So in terms of the Middle East in Q1, in Q1 2020, it was around 250,000 tons compared to almost nothing in Q1 2019. Most of that is semis, and most of that has come from either Iran, UAE, or Oman. Iran in particular has seen volumes increase very rapidly since the start of the year. And then there's also a very large increase in volumes from Southeast Asia, which is partly due to its proximity. So obviously, producers in Southeast Asia have easy access to the Chinese market, and also because of increased production capacity. So we've had obviously Alliance Steel in Malaysia has been selling steel into China fairly steadily, but that has increased. We also now have producers like Turkish coming online, and then we've also had Vietnamese producers selling fairly large volumes of billet and other products into China as well. So with everything that's going on, one note of caution is that really all of these, all that we talked about in terms of China over the last few minutes has been based on a very positive scenario where Chinese demand stays strong forever. Chinese prices are higher than other regions for some time, and the government issues a fairly significant amount of stimulus in order to support the market. But there are some issues that we should be cautious of. Firstly, in terms of actual end user buying, demand has recovered very strongly, but it still has not recovered to the level that some traders have been hoping for. If you had spoken to them a couple of months ago, some traders had become very optimistic about where demand would be, and inventory levels haven't fallen as far as some of them had expected. There's also a risk that iron ore prices are now moving so high in relation to the global steel market that there's going to be an even further, more dramatic retrenchment in steel production. In terms of what does happen in China, there are also consequences to what happens in China. So the stimulus that's announced in the next week may be very positive in the short term, but there may be consequences that need to be planned for in the next year or 2 years, longer. And there's always the question of what happens if there's another outbreak. Obviously, if coronavirus comes back anywhere in the world, then that's obviously going to be very serious. China has already seems to have successfully shut down secondary outbreaks in Guangzhou, in Wuhan, in Heilongjiang. There's only one outbreak still really running in Shulan and Jilin. But if another one of those outbreaks was to become more serious, then obviously all bets would be off. With that in mind, I'm going to call it a day and hand over now to Dan Hilliard in North America to talk about what's going on there.
Thank you very much, Tom. I am Dan Hilliard with Kallanish North America. I'm reporting to you just outside of Pittsburgh, Pennsylvania. I want to talk about the sort of pre-post COVID environment in the US, and we're going to talk about it through the lens of hot rolled coil. So just a brief note on the new normal. Normalcy has been sort of a weird concept for the US since at least the Great Recession. And in this most recent crisis, the US market experienced sort of a double whammy of the oil war and then COVID-19. And it's really pushed the market in ways and two places that it's really never experienced before. We've hit historic lows in the rig count. We've hit historic lows in construction employment, and we're really in uncharted territory. So judging the quality and rate of the recovery at this point is fairly difficult. We're dealing with a whole new rubric. The good news is at this point in time, things are most definitely better than they were, and the market appears to have tapped and might even have pushed off of bottom. So we're going to take a look at the pre-post COVID-19 world, as I'm branding that, through the lens of hot rolled coil, because that's the market that is closest right now to have completed a full market cycle. Oil is, to use the technical term, still a hot mess globally, and the construction season is in a very bizarre place because construction products really held out throughout the crisis. There were very few sharp drops. Now we're starting to see a little bit of decay because the backlog of projects is essentially empty, and there was no spending being done during the crisis itself. There's no capex available. So there's just too many open questions on those fronts. So for the purposes of this webinar, we're going to focus primarily on hot rolled coil. Good news is there's a lot to talk about with hot rolled coil. Just a brief overview. We started the year pretty great, near the technically perfect $600 a short ton level. In early April, that's when the social distancing really kicked in for the US, and you can see the precipitous drop pretty much as soon as those measures were announced. We waffled, as you know, quite a bit in the US about whether there would be a US-wide shutdown and what extent that would be done. When it became clear that there would be a top-down shutdown, prices sort of just dropped off the cliff. We touched bottom here on the chart at 460, but I know in some markets and for some unfortunate buyers, the price could have been closer to 440, and I heard rumors of 420 in some very limited markets. So definitely historically bad numbers centered around 460, but numbers we really have not seen since the Great Recession. Now, just recently, mills established a $500 price floor. And interestingly enough, that $500 price floor for hot rolled is acting as both a floor and a ceiling. We're seeing a good number of buys at 500, very few over. I hesitate to say no, but I have not seen any confirmed over 500. and the vast majority under 500 are in the 480, 490 level. So right there, right at that 500 level. And to the Mills's credit, that's largely having to do with holding the line and not caving into some pretty significant discounts on the asks. That said, transaction volumes are incredibly low, and they might remain that way for at least a little while longer. At this point, I would ask Paul to go ahead and run the poll. Want to get a short-term view from you, the audience, on whether hot rolled coil prices will stay relatively static or whether we might see a bump by the 4th of July. Paul?
Here we go, Dan. As before, Dan, the results are coming in a trickle. So it's fairly steady. At the moment, 50% of the audience have voted, so we'll let that carry on. We'll give it another 15 seconds or so. At the moment, the replies are pretty evenly split, actually. I'm not sure if that will surprise you or not. Give it another 5 seconds. And we're good. We've got 2/3 of the audience have voted. Seems to be stuck on that now. So there you go.
Okay. Well, that's a split spread if ever I've seen one. And it really reflects the reality of the market. Hard answers are very hard to come by. I do tend to agree with the up folks a little bit more, only because, and this is limited to hot rolled coil, there are good things happening, which I'm going to talk about here in the next slide. Thank you, Paul. Okay, so good things happening. As of 18 May, the Detroit Big Three are now back in business. And when the Detroit Big Three are back in business, that means all the transplants are going to be back. I believe even Tesla is going to be coming back soon. So auto has returned. And all three idled production around mid-March, just before the actual drop-off in prices. Some shifted to PPE production, but basically no one was buying anything from the steel market at that point. IHS Markit had already had auto production down this year by about 400,000 units to 16.4 million. They're now thinking it's going to be more like 12 to 13, and that's not a terrible number considering the unprecedented nature of a complete shutdown of the auto industry. I think the last time that actually happened would have been World War II, and even then it was limited. But auto's return is big news for the hot rolled coil market. It's likely no coincidence that the mills announced their $500 price floor / ceiling pretty much in conjunction with the Detroit Big Three coming back to work. It's debatable due to the nature of hot rolled coil pricing in the auto market, whether that's more sentiment driven or more strength driven, but it will lend a little bit of baseline capacity to the mills. So there should be some real strength behind auto returning. Okay, and I just briefly wanted to call attention to this. This is a spread of domestic prices called from our Kallanish indices. And you can see that the hot rolled coil price in North America, which is Midwest, Chicago hot rolled price, is still significantly above many other price points. And a buyer late last week told me he hoped the price in the US didn't rise too quickly. And if they did, he said he'd already had some attractive import offers in hand. That surprised me a little bit, but on a pure relative basis, when you look at the numbers, the US is still an attractive market. And some of the 232 measures, while they have not gone away, there has been delayed collection of tariffs, not specifically 232, but other tariffs. There's confusion on some of that import-export ground. So there's room for imports in the current market. Purely on a price basis, it's still a fairly attractive market. So there's going to have to be a delicate balancing act moving forward as we return to whatever the new normal might be, between domestic mills raising prices in response to somewhat returning demand, while still possibly fending off an import threat that really never went away. So without further ado, I want to pass you along to Adam. Thank you for listening, and stay safe and sane out there.
Thank you very much, Dan. Hello to everyone from sunny Frankfurt in Germany. I hope you're all holding up well in these difficult times. I'm going to discuss a little bit about the situation in the Middle East and Turkish steel markets, and also touch on prices later on. So to begin with, if we look at the crude steel production in the region in the first quarter, in the Middle East, it was slower than in previous years, but still up 6.8% on year. The Middle East has been one of the most fastest growing steel production regions in recent years, but it has also succumbed to the effects of the coronavirus outbreak. Q1 output was 10.24 million tons in total. Hadid, which is Saudi Arabia's largest producer, and Qatar Steel saw slight declines, the latter due to maintenance shutdowns. If you look at Turkey, Turkey showed clear production growth in the first quarter, suggesting the start of a recovery after a very, very tough 2019, which saw both production and consumption heavily impacted in the Turkish market. Iran, which is the largest steel producer in the Middle East, has seen output consecutive growth months of growth in output, crude steel output, for years now, but it started to waver. If you look at the last Iranian calendar year, which is the year through 19th of March 2020, Iranian semis and longs exports were each up 26%. Crude steel output was up 10% and finished steel output was up 6%. However, in the month through the 19th of April, the latest available figures, of course, we saw the impact of the COVID pandemic. Crude steel output still grew, but only by 2%, which is a very slow growth rate for Iran. Finished steel production actually fell 8% to just over 1.5 million tons, the first drop in a decade, according to the Iranian Steel Producers Association. And the lower tonnages are the result of the pandemic, and the association has argued that authorities should be offering incentives to exporters to support them in times of crisis. However, they're not doing so, as we'll see in a little bit. Exports in total that month actually halved to just over 220,000 tons. It's a big drop in Iranian steel exports. The government has recently introduced new regulations to control exports. So mills are now permitted to export only 25% of their production, and they have to offer 60% of it on the Iran Mercantile Exchange for sale to the domestic market. The government says this is necessary to ensure feedstock for local downstream industries. However, the domestic construction industry is going through a recession, and consumption of longs is therefore declining. So the steelmakers in Iran argue that export controls now are not such a great idea, especially since Iran has a target to increase production of crude steel this Iranian year to 30 million tons versus just over 27 million tons last year. Of course, this will be difficult if Iranian producers cannot export, because the exports have driven production growth in recent years. So the steelmakers are calling for all restrictions to be lifted immediately and for export incentives to be offered. If we turn to the GCC, It's been hit by a double whammy of the COVID pandemic and the slump in oil prices. Qatar Steel said at the beginning of the second quarter that it was producing at a reduced rate and only for the domestic market. This quarter, exports have been curbed amid higher competition from lower cost emerging market producers and declining margins internationally. Hadid in Saudi Arabia posted a 15% decline in first quarter revenue, and it sunk to a loss from operations versus a small income a year earlier. The firm's crude steel output fell 2% in the first quarter. However, this is before the real impact of the COVID pandemic will show on its figures. Jindal Shadid in Oman reported low steel production and sales in April compared to its monthly average in the previous fiscal year ending March 2020. And in the UAE, in the United Arab Emirates, mills have adjusted, meaning reduced production as a result of the COVID pandemic. The main producer there, Emirates Steel, put one rebar mill into maintenance in April. In Saudi Arabia, the Vision 2030 has been touted by many as the next driver for steel demand in the region. A lot of market participants had pinned their hopes on this, and projects were supposed to accelerate or really get going in earnest this year. But now, due to the pandemic, the Saudi government has said it wants to achieve 100 billion reals of extra spending cuts on top of the already announced 50 billion reals in March and the approved 2020 budget cuts of around 39 billion reals compared to 2019 spending. One very significant development in the market in the GCC has been the UAE banning the export of ferrous scrap for 4 months, effective from the 15th of May. This is to ensure that steelmakers have sufficient feedstock supply amid the pandemic. The UAE exports over 1 million tons of ferrous scrap per year. The majority of this goes to India and some to Pakistan. In 2019, for example, India imported 1.15 million tons of scrap from UAE, about the same as it did in 2018. Despite a large tonnage of scrap being generated in the UAE every year, the majority of it is not used by local mills. There have been calls in recent years, not least from Emirates Steel Chief Executive Saeed Al-Ramaithi, for local mills to utilize more domestic scrap in steelmaking. Some people say that this could be a test. The 4-month ban could potentially be a test for a longer term ban in the future. Turkey, of course, a major player, has seen, it started the year very well, considering 2019 was a very difficult year. Domestic consumption dropped, its exports faltered. However, it started 2020 very well. Q1 crude steel production grew, finished steel consumption surged versus last year. Of course, this was coming from a low base, but it was a very welcome recovery. However, exports decreased, overall steel exports, and imports increased in the first quarter. This was mainly, the export decrease was mainly led by less hot rolled flat products being exported. These were down by about a third in the first quarter, whereas rebar exports actually increased by almost 17% in the first quarter. But now the pandemic has struck, and the Turkish steelmakers have called for steel import quotas, essentially to mirror what the EU is doing. The country is on holiday next week for Eid, so we will see how the economy fares from June onwards. Coming to the prices, Turkish scrap has been extremely volatile in recent weeks, which is understandable, I guess you could say, considering the situation. Last week, Turkish mills booked numerous cargoes, deep sea cargoes, in the range of $249 to $252 per ton CFR Turkey, That's for the benchmark HMS 1 and 2 8020 scrap grade. These bookings were mostly from the USA and Baltic. However, at the end of the week, there was an EU origin scrap booking for 20,000 tons of HMS 8020 at $238 CFR, which surprised many in the market because of its low price. This was followed then on Friday afternoon by a US origin scrap deal, which was heard to have been concluded at $243 into Turkey. It's questionable if other suppliers will follow and offer these lower prices, as supply is said to be pretty tight in the market, especially as far as US origin material is concerned. This would be a good opportunity now to ask Paul if he could run the poll. I have a scrap related question for everybody to answer. I'm intrigued to hear the results. So when will Turkish scrap prices return to $300 per ton? Three options are Q3 of this year, Q4, or not until 2021. There could have been a fourth option, of course, which is never. However, we like to remain optimistic. So let's assume they will. So I'm intrigued to see what you select here.
Thank you, Adam. As usual, the replies are coming in. So we've got over 50% of the audience already voted. So we'll give them another 15 seconds or so. I'm not going to lead the audience, but I'll be intrigued to hear what you thought the answer will be, or what your thoughts are on this question afterwards. Give it another, give it another 5 seconds. Countdown. And done.
Okay, so the majority of you think it won't happen till next year, at least until 2021, which I think is reasonable, considering the majority of people don't expect demand to begin recovering post-COVID lockdown until Q3, and then only then it will be a very gradual recovery. So 2021 is probably the earliest we'll see a high figure like we did last year, $300 per ton. Thank you very much for your answers. So continuing with the slides now. The next price we have to look at is the CIS billet, which most recently has been supported last week by Chinese buying, which helped CIS billet mills close their June casting books. China started booking at 335 per ton FOB Black Sea initially, and this progressed to $345 per ton FOB from the same Russian seller. The two Ukrainian mills sold at $340 to $345 per ton FOB Black Sea. As you can see, scrap and billet prices have each fallen more or less $60 per ton since the beginning of this year, and the volatility seen in scrap is reflected in CIS billet prices. Finally, if we look at Turkish rebar, mills are facing very weak demand in export markets because of COVID-19 lockdowns in major destination markets. Although one producer managed to secure a fresh rebar deal to Hong Kong this week for 55,000 tons at $416 per ton CFR Hong Kong actual weight, which nets back to around $391 to $394 per ton FOB Turkey. Of course, this is a promising deal, and it's good to see Asian buyers back in the market and booking tonnages, large tonnages of Turkish rebar. However, at current prices, this deal still gives a pretty tight scrap rebar spread of around $150 per ton, which is a little bit tighter than Turkish mills would like it to be. I think they want it to be at least 160 today or more to be profitable. So prices will have to rise. Of course, there is the situation in the EU with the European Commission looking at adjusting safeguard quotas. This is also worrying suppliers in Turkey, not just of rebar, but of all steel products. The EU is a very important market, and if tonnages are reduced, this will hit mills badly. In any case, with lockdowns starting to ease in various Asian countries, Turkish mills are hoping to take more share from the region's demand. Demand right now is the problem, not prices, with COVID-19 restrictions and EU protectionist measures curbing buyer interest. To conclude, to summarize basically what I've said, the outlook is for, in the short term at least, is for reduced Middle Eastern steel production, which is not a normal thing, because Middle Eastern steel production has been growing consecutively for multiple years now. However, the region will not escape the effects of the pandemic, which will also delay the steel consumption recovery that was expected in the GCC, and especially in Saudi Arabia, due to, as I mentioned earlier, those Saudi Vision 2030 projects. However, now many of them will be delayed, and the demand recovery may come later only. Intensified protectionism and government trade measures, we're likely to see more of those, as the UAE scrap export ban shows. We've still got the GCC safeguard investigation ongoing, and we're waiting for the results of that. And as Tom mentioned earlier, there have been increased exports of mainly semis from the Middle East to China. And as long as demand remains subdued in the Middle East, in the regional domestic market, mills will have no option but to search for exports in countries like China, where the market has reopened and activity is much stronger than in the rest of the world. So thank you very much.
Thank you very much, Adam. What we'll do now, I'm conscious of the fact that we're running later than we anticipated, so we'll ask the other panelists to jump back on screen, and we'll deal with some of the questions that have been coming through from the audience. We won't have enough time to answer them all, been quite a lot, so what I'll do, I'll pick some of the most frequently occurring questions. Emanuele, I'll start off with you because it was the first question we received, and it was during your presentation, which was a comment from somebody in the audience about a slight dependence, that some of your comments are dependent on the EU quota rates for imports and the additional duty for Turkey. Do you have any updates or opinions on that, given obviously what we were reporting last week on the European Union focused on anti-dumping measures for Turkish hot rolled coil?
Well, as I said very briefly, on the anti-dumping measure, the investigation has begun officially, and by the end of the year, they should take a decision if they want to impose provisional measures. It's difficult to say, as usual. We have to remember that every time during the last years that these investigations have started, they all resulted in measures. So there's a very high likelihood that measures will be imposed. And it's also a fact that we've been talking about this potential measure on HRC from Turkey for the last 2 years. So it was only a matter of time. It's true as well that Turkey is responding in a way more strongly to the current investigation. So there will be a very heated conversation, in my opinion. On the safeguard, as I said, again, the new safeguard quota start the 1st of July. Eurofair is asking a cut of 75%, which is not realistic, in my opinion, at least. But it's very unlikely that the European Commission won't listen to the requests coming from Eurofair, but also from a lot of politicians across Europe of a review of the quotas. So it's likely that the quotas will be reduced, not probably by as much as 75%.
Thank you very much, Emanuele. Running through the questions, one that came up because Thomas was presenting next. Thomas, somebody with their eye on exporting to the Chinese market by the look of it, was asking a question of will China continue to be an importer, obviously be a net exporter, but will it continue to be a net importer, an importer during the rest of this year?
Thanks, Paul. Yeah, as you say, it will remain a net exporter, but that gap is certainly going to be narrower this year than last year. Imports so far have remained really quite robust. That doesn't mean that sentiment hasn't wavered from time to time. So, we've had some weeks when no long distance imports have been booked. There's points when Chinese buyers get nervous about long distance cargoes. So Middle East, for example, or even India as well. But you see fairly steady volumes for Malaysian, Vietnamese steel, and Korean HRC has been very popular. But considering that the outlook for the Chinese domestic market is more positive in the coming months relative to most of the rest of the world, possibly all of the rest of the world, there's likely to still be opportunities for sales into China for at least the next quarter or 2 quarters.
Thank you very much, Thomas. Scrolling through the questions, I also, Dan, this cropped up a couple of times. People focused on your market. Obviously, the mills have managed to establish a floor of $500 metric short ton for hot rolled coil. Can you see it getting up to $600 this year?
$600 seems so close and yet so far away. A lot of things would have to happen for 600 to happen. Basically, we would have to see firm auto demand. We would have to see contract negotiations in not auto, but other large scale projects. You'd have to return the mills to a base load. Right now, the capacity utilization is still in the 50s, and that makes $600 hot rolled, which is the technically perfect number between 6 and 660 is good hot rolled. Very difficult to achieve. I think it'll be quite some time before we get up to the 80, 85, 90% capacity utilization that you would need to realize $600 hot rolled on a sustainable basis, say it that way. Thank you.
Thank you very much, Dan. Scrolling through again, got quite a lot for Adam at the end. I'm not going to put them all to you, Adam, because we'll be here for another 30 minutes. But an interesting one is implementation of 10% anti-dumping measures from Egypt to Turkey started last week. Will this have an effect on prices, or is the Egyptian market too small to have an overall effect?
It's a good question. I mean, it relates more to flat products, because there's an anti-dumping duty already in place on rebar from Turkey. So there hasn't been much trade of that product going in that direction since the end of 2017, I believe. I think it's not going to have, obviously the Turks would rather have the option of selling to Egypt if they could, especially now where markets are hard to come by with the pandemic affecting activity in all regions. However, I don't think it will have a huge impact overall on their sales. Yeah.
Thank you very much, Adam. I think we've got plenty of other questions, but I think what we'll do is we'll call it a day there. And I'd just like to remind everybody that this whole webinar is available by video link, which we will send to you in the next, hopefully tonight, if not by tomorrow morning. If you have any further questions, please send your emails to info@kallanish.com, and what we'll do is we'll get back to you with a combined summary of the questions, but also our panel's answers to your questions. We'll get that out to you hopefully within the next 4 or 5 working days. So that's info@kallanish.com. If you also want to let us know any future topics, any specific markets or sectors you'd like us to focus on, we'll be very happy to do so. And all that remains for me to say is to say thank you for the panel. Thanks to all of you for joining. Please stay safe. We hope to remain in contact with all of you and hopefully to see you at some point before the year's over. Thank you very much and goodbye.
Thank you, Paul.
Thank you. Take care.